When you study market structure closely, you'll notice something important: price does not always reach key zones before reversing. Sometimes the market turns early, sometimes it accelerates without giving obvious pullbacks. This behavior is not random, it happens because of order flow. Order flow explains where institutions are active, why price reacts earlier than expected, and how smart money positions itself before the obvious levels are reached. In this video, we're going to explore order flows, the different types of order flows, how to correctly identify a valid order flow on the chart, and most importantly, how to use order flow in your trades. If you want to learn advanced trading concepts, entry techniques, smart money strategies, and master your trading psychology for disciplined execution, make sure to hit the like button and subscribe the channel for high-value trading content. Order flow represents the areas where institutional traders, smart money, hides their positions or where they are most likely to initiate their positions. It reflects where aggressive buying or selling originated, and where unfilled institutional interest may still remain. Order flow can be bullish or bearish, depending on the prevailing market structure. In a bearish market structure, bearish order flow is identified by the last bullish price movement before strong selling begins. These bullish candles represent institutional selling disguised within upward price action. In a bullish market structure, bullish order flow is identified by the last bearish price movement before strong buying begins. These bearish candles indicate areas where institutions accumulated by positions before driving price higher. Understanding order flow allows you to locate where smart money entered the market, not where retail traders reacted. Order flows can be classified into three categories: mitigated, unmitigated, and failed order flow. Each type plays a very different role in trading decisions. An unmitigated order flow is one that price has not yet revisited after a valid break of structure. Unmitigated order flow represents untouched institutional interest and offers the highest probability trading opportunities. A mitigated order flow is one that price has already revisited and respected after the break of structure. Once price taps into an order flow and reacts from it, the institutional orders in that zone are considered filled. These zones lose their effectiveness and should not be reused for future trades. A failed order flow occurs when price breaks and closes decisively beyond the order flow zone. This indicates that institutional interest at that level has been invalidated. Just like mitigated order flow, failed order flow is no longer useful. Out of all three, only unmitigated order flow is valuable for trading. To identify a valid order flow, the first requirement is a clear and valid break of structure. Without a confirmed break of structure, any order flow marking is premature and unreliable. Once the break of structure occurs, identify the last opposing price movement that led to the impulsive move. In a bullish break of structure, this would be the last sell move before the strong buy impulse. In a bearish break of structure, it would be the last buy move before the sell impulse. Any interaction with an order flow that occurs before a valid break of structure is considered irrelevant and has no impact on the order flow's effectiveness. Only mitigations that happen after the break of structure are meaningful, as they reflect active institutional participation aligned with the new market direction. A valid order flow typically contains at least two candles. A single candle is classified as an order block, which is a more refined entry zone. Order flow, on the other hand, represents a broader institutional activity area. Another key point to remember is that once an order flow is mitigated, you can shift your focus to next one, and if the next order flow is also tested, you can continue to proceed to the following order flow and so on. Order flow zones are areas where institutions are most likely to re-enter the market. These zones provide context, directional bias, and high probability reaction points. When combined with market structure, liquidity, and inducement, order flow becomes a powerful framework for building consistent trading strategies. In the next topic we will explore how the order flow concept can be utilized to manage a profitable trading strategy and execute trades effectively. Let's consider a bullish market scenario where the overall market structure is clearly bullish. The first step in this process is to identify unmitigated bullish order flow on a higher time frame, preferably positioned at a deep discount level or near a key liquidity area. This higher timeframe order flow establishes your directional bias and tells you where institutions are most likely to re-enter the market. Once price returns and taps into this unmitigated bullish order flow, the next step is execution refinement. At this stage, you drop down to a lower time frame, such as the 15-minute or 5-minute chart, and observe how price reacts. Rather than entering immediately, you wait for confirmation in the form of a market structure shift, which signals that buyers are regaining control and institutional participation is active again. After a valid structure shift is confirmed on the lower time frame, you then look for a precise point of interest to execute your trade. This could be a fair value gap, a mitigation block, a breaker block, or an order block. In this example, we identify a bullish order block. When price retraces back into this order block, you execute a buy position, placing your stop loss safely below the order block on the lower time frame. For take-profit targets, you have two strategic choices. You can aim for nearby liquidity on the current time frame for a more conservative and higher probability exit, or you can target major higher time frame liquidity levels to capture extended moves and maximize your reward-to-risk ratio. This structured approach ensures that you are trading in alignment with institutional order flow, entering with confirmation and precision, rather than reacting emotionally to random price movements. That's it, traders. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.